Hello, everyone. This is John Hannigan with Principal Wealth Partners. Welcome to our mid-year tax planning webinar for June 2020. Now is a great time to brainstorm various strategies, especially since the 2019 income tax filing deadline has been extended to July 15th of 2020. Some of the ideas mentioned may help reduce your current tax liabilities. Others may allow you to minimize future tax liabilities. The various topics we'll discuss today are gifting the most appropriate assets to charities and/or loved ones, maximizing contributions to your retirement accounts, investing tax efficiently, track those deductible expenses, and our last topic is review your estate plan. Let's discuss gifting. Consider giving appreciated securities instead of cash. If you're interested in gifting to your favorite charities or loved ones, it pays to evaluate the best way to do so. By donating appreciated securities purchased more than a year ago to a public charity, you are generally entitled to a fair market value deduction, and you may even be able to eliminate capital gain taxes. Together, that may enable you to donate substantially more than if you had to pay the capital gain taxes. The enclosed chart shows the difference in selling stock and giving the proceeds to a charity or giving appreciated shares directly to the charity. When it comes to giving to loved ones, instead of writing a check to a loved one in a lower tax bracket, it may be better to give an appreciated asset. Just remember that your cost basis becomes their cost basis. Let's move to our next slide, which is maxing your retirement accounts. When you have earned income, you can contribute to an IRA up to the maximum annual limit of $6,000 in 2019 and $6,000 in 2020. If you're age 50 or older, you're allowed to contribute an additional $1,000 per year. If you have more than one IRA, the total contribution to all your IRAs can't exceed the annual limit. The Secure Act, signed into law on December 20th of 2019, removed the age limit in which an individual can contribute to an IRA. The top age prior to the law change was 70 and a half. The Roth IRA does not require minimum required distributions. However, with the Roth, you will only be able to contribute if your income falls within the allowable income limits. Next, at Principal Wealth Partners, we take the tax efficiency of your investments very seriously. We use a number of techniques to minimize tax liability. Tax loss harvesting is the practice of selling a security that has experienced a loss. By realizing or harvesting a loss, investors are able to offset taxes on gains. The sold security is replaced by a similar one, maintaining an optimal asset allocation and expected returns. In addition, we're fervent believers in asset location as well. In real estate, it's location, location, location. In investing, the same bit of wisdom also has a place. Where you put your investments, meaning the type of account you choose, can make a major difference in how much you can earn after tax over time. That's because different investments are subject to different tax rules, and different types of accounts have different tax treatment. Sorting your investment into different accounts, a strategy often called active asset location, has the potential to help lower your overall tax bill, as you can see here in the chart. Moving on to deductible expenses. Please track your deductible expenses carefully. The IRS allows you to claim deductions for a whole list of items. The only catch is that you have to keep accurate records to be able to prove the deduction. Some common deductible expenses include mortgage interest you pay on up to 2 homes, state and local taxes, medical and dental expenses that exceed 7.5% of your adjusted gross income, and, as previously mentioned, charitable donations. Our last topic is reviewing your estate plan. Your estate plan should be analyzed periodically as regulatory rules and your personal situation can change. On this chart, we've highlighted the changes that might warrant a review of your estate plan. Also, double-checking the beneficiaries on insurance policies and retirement accounts is also suggested annually. In summary, there are many considerations to keep in mind when it comes to taxes. As always, please reach out to any of us here at Principal Wealth Partners if you have any questions or would like to discuss this further. Thank you for listening.